the opportunities in the region, I'm going to focus on Latin America, are arguably the most vast and the most interesting in emerging markets. And the good news is that many of the challenges that we face as investors and as people doing business in the region are ones that we can fix just by changing the way we approach things and our attitude. In fact, the biggest challenge is our own misapprehensions about how business is done in Latin America. So I'd like to address that question. The notion that we need to eschew is that we will show up with capital or with goods and services to sell, and because the growth trajectory is positive, because the macro environment is improved, and because of deep needs for capital and innovation, the red carpet will be rolled out for us Canadians. And that's not necessarily true. Many of the themes have already been touched upon by the previous speakers, but I'm going to amplify them through the prism of an investor day-to-day in LATAM. Let me start with some of the things that we actually can control, just to get those out of the way. Fortunately, there's a lot of them. But in truth, the most significant, which I think Warren touched on, is this topsy-turvy macro world that we live in. This overall economic environment creates uncertainty. It's not really because of the particular failings of any government in Latin America. I mean, there's a couple that are pretty faulty, I would say, but in general, it really has to do with a much broader set of circumstances. And I think if you discuss it, say, with the Brazilians or with the Colombians or the Mexicans, fingers are often pointed at the improvisation taking place in the large central banks of the world, particularly the Fed, which has arguably created a glut of liquidity that is pushing up prices of practically everything in emerging markets and in specific Latin America. Now, this increase in discretion or more experimental policy begets improvisation in emerging market central banks and in fiscal authorities. Indeed, the IMF, which is supposed to be the defender of orthodoxy, indeed accepts that the experiments taking place in Turkey or in Brazil are not a bad thing, but actually a good thing. And this idea of being called unorthodox, which among economists is a very bad word, seems to be diminished. That stigma is almost gone compared to, say, 5 years ago. So improvisation means uncertainty. Now, just focusing on Brazil, I am agnostic as to whether the policy pathway in monetary policy making is right or wrong. But it is more discretionary than it was, say, 5 years ago. And it could be the right path, actually, but we'll have to wait to find out. There's not that much data. And by waiting, it means that we do, by definition, need to be more vigilant about inflation as investors. Now, having said that, this phenomenon that I'm describing, this improvisation, might well more be a BRIC phenomenon than a LATAM phenomenon, because in Chile, Colombia, and indeed in Mexico, which hasn't changed their rates for, I don't know, 5 years or so, there has been a much closer hewing to what we used to call orthodoxy. Now, as part of this, there is a simple challenge to all of us that even without the goosing of LATAM markets by the Fed, if you believe that, these countries have been booming for 8 years. So on the back of better policy, demographics, all the structural tailwinds that we have come to know, with maybe the interruption of 08 and 09, these countries are doing well and have been doing well for a long time. So valuations of a number of assets have moved much higher. Financial investors can't just close their eyes and buy a Colombian or Mexican asset and hope for the best, because the risk rating or re-rating has already occurred. Spreads have compressed, valuations have gone up, et cetera, et cetera. So let's just look at Colombia, for example. This country is pretty interesting. A local investment banker I used to work with at Goldman Sachs, there's a sign of the times right there, told me recently, if you're looking for bargains, go home. So I went home. Low leverage businesses are going for 3 times book currently, and Colombia saw $7 billion of IPOs in 2011, which was not a very good year for the rest of the world, which is more than Brazil, a country 5 times the size of Colombia. So who are buying? And this picks up on the themes of what's going on in local markets among local players. Local pensions, Colombians repatriating their money from abroad. They think buying peso-denominated Colombian assets are a better bet than buying US dollar stocks. That's interesting. Let's pause on that for a moment. That is diametrically opposed to even 5 years ago. Behind them are Chileans, Chinese, Mexicans, Peruvians, Brazilians, and Venezuelans. This is part of this South-South trade and investment flow theme that we see driving emerging markets. And why is this happening? Well, it's happening at least in part because some of the gaps that used to obtain in Latin America, for example, and in other emerging markets too, have begun to be narrowed. One of the gaps was the access to capital. Well, bankers like myself and others have spent the last decade providing financing to good companies in Latin America, and they are now in a position to grow. They don't have a huge scarcity of growth capital. And second, there's also that skills and outlook gap. And again, the new generation of Latins who have all gone to Harvard and Yale and come back to start or to grow businesses is a phenomenon that is quite breathtaking when you see it up close. So this, combined with the growing overvaluation of real exchange rates, which has occurred, leads to some pretty funny kinds of outputs. For example, a banker, a friend of mine in New York, mentioned to me the other day that he was trying to hire an economist from Brazil to join his team. And he said, you know, I would love to move to New York, but I won't move for a pay cut. This seemingly upside-down world only seems upside down to us, not to anybody else. And this is an important issue. It does, though, and this is the most important point, present real challenges for those of us who are looking to invest or to do business in the region. There are competitive local sources of capital, and that there are all sorts of very smart people who know just how to mobilize it. And then there's another element, which I think is a subtle point, but probably a more important one than just the access to capital and maybe the access to sophisticated techniques. And that is, we may actually be at a disadvantage. There's a difference between risk and uncertainty. US banks, despite the news from JP Morgan recently, are very good risk managers. They manage risk. It's a known, analyzable phenomenon. US banks, Wall Street, are not good uncertainty managers. And actually, the skills that really pay is uncertainty management. And the Brazilians, the Colombians, the Chileans are very, very good uncertainty managers. And so it is not a surprise that Brazilians, for example, dominate the EPC business in Peru, in Colombia, and elsewhere in South America. They understand the shifting of political sands. They understand the shifting of regulatory measures. They understand it because they've lived it for generation after generation after generation, and they've survived. This, more than anything, is the real hurdle. So what does this mean? Well, it means that we have to dig deeper, number one, into local markets, and we have to find that overused word, but yes, partnerships. Because partnerships is the only way to navigate what is a huge opportunity. A key element of those partnerships, however, has to be that we come as equals. It's the difference between the G8 and the G20 is the difference between the old style investing in Latin America and the style that we need to do today. On this theme, it is important to note, especially for those people looking to do business as suppliers, as providing both goods and services in Latin America, that, say, in a country like Brazil, it's extremely important to park whatever prejudices you might have at the door. Foreign investors tend to fail to grasp that a country like Brazil is an exceptionally big, diverse, and sophisticated country. And we have to depart from the notion that folks who made a lot of money in, say, in Rio, made it by tanning hides or something like that. They've done it by building airplanes. Typically, and this is important, they expect their suppliers, as any North American business would, to be on site and to provide very good service and a huge commitment to their business and their country. Without it, it won't work. Indeed, I had the opportunity to spend some time with the Governor General on his visit to Brazil recently, and every Canadian business person who spoke, who testified, raised the same question. If you do not provide a just-in-time service, the Brazilians do not want to deal with you. So that means being there. Indeed, if you think about the foreign businesses that have done the best in Brazil, they're the businesses that have dug in for decades and have quietly done their business, satisfying their customers. Companies like VW, Global Pharma. Not sexy, don't hear a lot about it, but you look around and you see a lot of VWs. This is not a maquila economy. Finally, let me talk maybe a little bit on the financial investing and on a couple of the broader themes that have affected that. The first is, and maybe this is common to the comments I'll make, emerging market currencies, at least the perceptions in the market of emerging market currencies, have changed as of late. This is very important. The general conventional wisdom was always that they will appreciate. That is not necessarily true anymore, which is, I think, explains why local bonds and local equities have underperformed substantially their US dollar counterparts. The reason for this is that the volatility associated with a number of these currencies, say the Mexican peso is a good example, has increased a lot because these currencies trading has become part of the risk-on, risk-off trade, mainly because they are a very favored hedging tool of people with a lot of other things going on in these countries. So as a result, you're seeing this underperformance. Now, interestingly, US dollar bonds, sovereign bonds, rather boring, which most of us stopped trading a long time ago, are now the toast of Wall Street. It's very much a sign of the times. Now, having said that, and this was alluded to earlier as well, the broader secular theme of underinvestment by institutional investors in EM is still true. And JP Morgan recently did a study on the underinvestment and the size of the underinvestment. And just to get to a 5% allocation to stocks and bonds in EM among the institutional investors in the world would be close to $1 trillion of investment. So we're in maybe a trough, but the secular trend continues. And it is true also that these local assets, stocks and bonds, are more insulated today than they ever were to shocks. And what's the shock we worry about? A crack in commodities, which would likely come from a slowing in China, which I don't expect. But nonetheless, this is a very, very singular vulnerability. But because these countries have greater access to local capital and can float their currencies and have learned to float their currencies, the impact would probably be a lot less. They don't have a lot of external debt. So if global growth comes back, you can expect that as people kind of turn their back on 1.7% 10-year treasuries in the US, just as was said earlier, these markets are likely to return. So as Canadian investors, the hurdle is higher. It is higher because we have more local competition, because evaluations have been moving higher for several years, and because we live in an uncertain world, because the basic assumptions of policy, particularly monetary policy globally, have shifted and are still very much unclear. But I did want to leave on an optimistic note. Canada's brand is still very, very solid in Latin America. There is a warmth towards a Canadian investor. There's a warmth shared to the Governor General and his delegation, which I think was palpable in Brazil. We've moved on to a good new equilibrium, and that brand still holds. Second thing is, yes, the hurdle is higher, and Chinese influence is very, very strong in Latin America, as it is in many emerging markets. But there is a very interesting leitmotif in many of the discussions you have with local officials that they recognize the downsides as well as the upsides of China investment. Issues to do with mercantilism, dumping, things that are not always the positive, and also the management of their currency, which they view as part of their macro problem too. And finally, there is the point that US and European, particularly Spanish, institutions are retracting because they have to, because they have a lot more going on that they need to deal with at home, particularly the Spaniards. Santander has been selling, not buying, and this creates an immense opportunity for Canadian investors and Canadian business people to grow and to build in Latin America. Thank you very much.